Hello and welcome to another Daily Dose of Insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today it's Wednesday, so we typically take a look at the key charts that move the week, so to speak, both on the leasing as well as on the container trading side. Most notably, typically Far East to Europe and the US trade lanes on the leasing side. And then, of course, the Asia and Americas markets on the container trading side. Let me quickly share my screen to give you a little bit more guidance of what I'm talking about. Today, of course, also we have some inflation data coming out in the US. So that's, of course, something to watch out for, which will certainly also influence some of these charts. So what do we see here? This is market data from our Insights, a product in xChange where we track container trading prices. So these are 40-foot high cube cargo worthy containers in 3 US locations: Chicago, Dallas, Houston, and Ningbo, just as a comparison here in China. And what we see here is that a well-known graph that we saw sort of container rates in Asia spike into sort of the early summer of last year, and since then slowly but surely tapering off as we saw a decrease in demand for typically one-way containers or container for purchase in China and China main ports. And on the flip side, in the US, we saw since around about middle of 2024, we saw an increasing trend, particularly if you here look at Dallas. Slowly but surely prices are creeping up. There's some factors might be attributed to the upcoming inauguration of Trump, including his policies on tolls, on customs, as well as on tariffs. As well as of course on fiscal demand stimulus, fiscal domestic demand stimulus in the US, essentially increasing the demand for containers and thereby increasing prices. Some factors might also be the strikes, of course, on the US East Coast, pushing up prices, particularly here towards December or November, December, and then early this year. This is on the trading side. On the leasing side, the picture is similar as here. You always have to look at both the pickup location as well as in the drop-off location. Shanghai, Dallas in this case, and Shanghai, Houston in the sort of purple line. And what we see is that leasing rates sort of spiked here around the middle of last year again. This is where the gap between prices in China and in the US were highest. And since then, that gap has narrowed, and hence also one-way leasing rates have come down. I think what's very interesting here is that over the past couple of weeks now, we've seen an increase in demand for Trans-Pacific one-way containers again. So there's some pickup, potentially due to the run-up to Chinese New Year, but potentially also because there's overall sort of a higher attractiveness of SOC containers in the market, because you always then also have to look at the freight rate differential between SOC slots and COC all-in rates, so to speak. So I think two very interesting charts. Let's see and let's observe how the upcoming inflation print in the US impacts some of these factors. And then, of course, in I think 5 days, we'll see the inauguration of Trump. So that's going to be also very interesting to look at how that's going to impact markets. Now, that's it from me from today. Just a quick food for thought, maybe. Have a fantastic start into the day wherever you are, and talk to you all on Friday. Take care.